You are watching Market Pulse Daily, heading into the new week, Sunday, May 31, 2026. If you want a clean daily read on macro and market risk, subscribe for the next briefing. Geopolitical tensions escalate, markets brace for impact as oil and gold react. Today's agenda: week in review, Bitcoin and crypto, gold and silver, oil and commodities, Forex and dollar, stocks outlook. Let's start with a look back at the week that was. This week in markets was defined by a potent cocktail of escalating geopolitical tensions and stark warnings from the European Central Bank. We saw Iran's actions and naval mining in the Strait of Hormuz send ripples of concern through global oil markets, while the ECB flagged serious financial stability risks for the Eurozone, amplifying recession fears. Despite these significant undercurrents, major stock indexes like the S&P 500 and Nasdaq managed to post weekly gains, fueled by tech sector strength and some short-covering rallies. However, this optimism feels fragile, disconnected from the underlying structural risks in the global economy. Gold and silver, true to form, continued their ascent, attracting safe haven flows. Bitcoin, meanwhile, demonstrated its role as a hedge against fiat instability and geopolitical shocks, showing remarkable resilience. The key takeaway from this week is the persistent disconnect between market highs and underlying fragility, suggesting that a significant risk-off event remains a distinct possibility. We'll be watching diplomatic progress and central bank signals very closely as we move forward. Now let's dive into the world of digital assets. Here's where things stand right now in the crypto markets. Bitcoin is holding steady, consolidating in that about $74,000 to about $75,000 range. This resilience is significant, especially when you look at the underlying metrics. Exchange reserves are at multi-year lows, meaning there's less Bitcoin readily available for sale. And crucially, whale accumulation is at its highest point since 2013. This isn't just random buying. It points to larger players strategically accumulating Bitcoin, likely seeing it as a hedge against the geopolitical and economic uncertainties we're facing. Ethereum and other altcoins are mostly following Bitcoin's trend, showing modest gains. The market sentiment is still in fear territory, but the price action tells a different story, driven by institutional interest and strategic holding rather than speculative frenzy. We're watching that about $75,000 resistance level closely. A confirmed break above could signal further upside, especially with continued institutional inflows and those strong accumulation trends. Remember, while the medium-term outlook is positive for Bitcoin as a hedge, traders should still anticipate immediate high volatility and potential flash crashes before any sustained recovery takes hold. From digital assets, let's turn to traditional safe havens. Here's where things stand with gold and silver. Precious metals are continuing their impressive upward trend. Gold has now breached about $2,600, hitting new multi-year highs, and silver is actually outperforming gold, boosted by expectations of strong industrial demand, particularly from the green energy transition. The primary driver for both, however, remains the escalating geopolitical tensions in the Middle East. This is a classic flight to safety scenario playing out in real time. Investors are clearly seeking refuge in these traditional safe haven assets as global uncertainties mount. The market reaction is a direct reflection of this demand, with prices climbing steadily. Looking ahead, any further escalation in the Middle East conflict will likely push gold and silver even higher. We're also keeping a close eye on industrial demand indicators for silver, which could provide an additional tailwind. The ECB's commentary on financial stability will also be a key factor to monitor. From safe havens to the energy markets. Here's where things stand with oil. WTI crude saw a significant drop of over 5% this past week. Now, this might seem counterintuitive given the ongoing supply disruption concerns, especially with events in the Strait of Hormuz. However, the market is clearly prioritizing demand concerns. Disappointing economic data out of China has weighed heavily on sentiment, suggesting a slowdown in global economic activity. This, combined with rising crude inventories, has more than offset the impact of OPEC plus production cuts. The surge to over about $93 per barrel earlier in the week proved short-lived. Looking ahead, we'll be watching upcoming economic data very closely for any signs of demand improvement. The long-term energy transition also continues to cast a shadow over future oil demand forecasts, suggesting that upward price momentum might remain challenged. From commodities to currency markets. Here's where things stand with the currency markets. The US dollar index, the dollar index, is currently trading around 104.2. We're seeing some mild weakness in the dollar against the broader euro basket. This comes as markets are digesting a lot of information, including those concerning warnings from the European Central Bank about financial stability. Any shifts in central bank policy, especially from the ECB and the Federal Reserve, will be the key drivers for currency movements going forward. A weaker dollar can sometimes signal a move towards riskier assets, but in this current environment, it's more about anticipating policy divergence. We'll be watching closely for any new statements or policy decisions from these major central banks, as they will undoubtedly impact currency pairs like the euro to US dollar and the dollar index itself. Now, let's look at the stock market's performance. Here's where things stand with the stock market. Major US indexes, including the S&P 500, closed at record highs heading into the holiday weekend, with the S&P 500 having its best week in months. This rally was largely powered by the technology sector and some positive earnings surprises. However, it's crucial to note that this market optimism seems disconnected from the underlying structural fragility and escalating geopolitical risks we've discussed. Analysts are warning of a potential risk-off event, and the Nasdaq is being specifically watched for a potential pullback to that 725 support level if diplomatic progress stalls. So, while the charts show gains, the underlying sentiment is cautious. We'll be watching US-Iran diplomatic developments very closely. Any escalation could trigger that predicted correction, while de-escalation might allow the rally to continue, at least in the short term. The Nasdaq's behavior around that 725 level will be a key indicator. Finally, let's look at what's on the calendar. Looking ahead to the new week, it's a busy one for economic data and central bank commentary. U.S. markets are closed on Monday for Memorial Day, but starting Tuesday, we'll get a stream of important U.S. economic releases. Keep an eye on initial jobless claims, existing home sales, and crucially, PPI inflation data on Friday. The Federal Reserve's Beige Book will also provide a snapshot of regional economic conditions. On the central bank front, ECB President Lagarde and Federal Reserve Governor Williams are both scheduled to speak, and their words will be closely parsed for any hints about future monetary policy. For the crypto markets, the Bitcoin ETF weekly flows report is due Wednesday, which has been a significant driver recently. The FOMC minutes from the May meeting will also be released, giving us more insight into the Federal Reserve's thinking. The key takeaway here is to watch for any surprises in inflation and labor market data, as these will heavily influence market expectations for interest rates and central bank actions. As we head into the new week, watch for continued diplomatic developments between the US and Iran, and listen closely to any further signals from the ECB regarding recessionary risks. Thank you for your attention, and we will see you again tomorrow.